Warren Buffett just made his biggest healthcare bet ever. Ray Dalio increased his position in one stock by 667%. And Bill Ackman, who never touches tech stocks, just dropped $1.3 billion on his first Magnificent Seven purchase. What do these billionaire investors know that you don't? I'm talking about over $4 billion in combined smart money investments. And here's the thing, these aren't random picks. Each of these stocks actually crashed before the smart money swooped in to buy. By the end of this video, you'll know exactly what they're betting on and why timing could be everything. I spent weeks analyzing over 200 Q2 2025-13F filings to find the pattern, and 3 stocks kept appearing across legendary investor portfolios. We're talking about companies with a combined market capitalization of $7 trillion, but here's the twist that nobody's talking about. United Health Group plummeted 45% from its peak, and that's when Buffett bought the blood in the streets. Nvidia trades at 50 times earnings, and everyone thinks it's overvalued. Yet Renaissance Technologies increased their position by 897%. Amazon seemed overpriced to Bill Ackman for years. Then he suddenly dropped $1.3 billion on it. There's a method to this madness, and I'm going to break down exactly what these billionaires are seeing. Let's start with the most shocking move of all, Warren Buffett's healthcare rescue mission. Picture this. March 2025. United Health Group crashes 45% in just 3 months. Medical cost inflation hits 7.5% versus the 5% that Wall Street expected. Operating margins compressed to just 2.4%, and suddenly this healthcare giant that everyone thought was bulletproof is bleeding money. The stock falls from $630 all the way down to $346, and Wall Street is in full panic mode. Then Warren Buffett strikes. Berkshire Hathaway drops $1.57 billion on United Health, making it their largest new investment of the quarter. We're talking about 5.04 million shares. This is Buffett's first major health insurance bet in his entire investing career. But he's not alone. Michael Burry, the guy who predicted the 2008 financial crisis, makes United Health his #1 holding and even adds call options on top of his common stock position. So what are they seeing that everyone else missed? The numbers tell the real story here. United Health just reported quarterly revenue of $111.6 billion, up 13% year over year. This isn't some struggling company. This is a financial fortress with 4 dominant business lines. United Healthcare, their insurance arm, controls 53.7% of total revenue at $298 billion annually. Optum Rx brings in 24% at $133 billion. Optum Health generates 19% at $105 billion, and Optum Insight rounds out the portfolio at 3.4% with $18.8 billion in annual revenue. But here's the genius move that Wall Street completely missed. While everyone was panicking about medical cost inflation running at 7.5%, United Health was quietly implementing pricing adjustments for 2026 that anticipate trends accelerating to nearly 10%. Translation: they're building margin recovery directly into next year's contracts. They're not just reacting to inflation, they're getting ahead of it. And then there's the dividend goldmine that smart money absolutely loves. United Health pays $8.84 annually. That's $2.21 quarterly. And they've increased their dividend for 16 consecutive years with an average growth rate of 14.18%. The next ex-dividend date is September 15th with payment on September 23rd. So the smart money is literally getting paid while they wait for this recovery to play out. Now let's talk about the AI infrastructure king that has everyone confused. Nvidia. Here's the skeptic's dilemma in a nutshell. Nvidia trades at 50 times earnings, making it look obviously overvalued to most investors. Then Ray Dalio's Bridgewater Associates increases their Nvidia position by 667% to $1.14 billion, making it a top 3 holding. Renaissance Technologies, one of the most successful quantitative funds in history, adds $1.05 billion, increasing their position by 897% to make Nvidia their second largest holding. What are they seeing that everyone else is missing? The answer lies in understanding that this isn't about current earnings. It's about the infrastructure transformation happening right in front of us. NVIDIA's Q2 2025 results were absolutely unprecedented. $46.7 billion in revenue, up 56% year over year. But here's the real kicker. Their next-generation Blackwell architecture is experiencing what CEO Jensen Huang calls the fastest product ramp in company history, generating $11 billion in Q4 2025 revenue alone. Let me put the Blackwell production scaling in perspective for you. Q4 2024, they're expecting to produce 250,000 to 300,000 units. Q1 2025, they're projecting 750,000 to 800,000 units. And these Blackwell chips are priced 60 to 70% higher than their previous H200 architecture. We're not talking about incremental improvements here. This is a complete technological leap. Jensen Huang has made a bold prediction that's driving all this smart money interest. $3 to $4 trillion in AI infrastructure spending by 2030, with NVIDIA positioned to capture approximately 60% of all data center capital expenditures. They're not just selling chips, they're building the backbone of the AI economy. And here's something most people don't know. NVIDIA is expanding U.S. manufacturing with facilities in Arizona and Texas that will produce up to $500 billion worth of AI infrastructure domestically. This isn't just about riding the AI wave, it's about controlling the entire supply chain. The smart money logic here is crystal clear. They're not betting on NVIDIA's current 50 times earnings multiple. They're betting on a company that has a near monopolistic position in the most important technological transformation of our lifetime. 3 mystery customers account for 39% of NVIDIA's revenue, and when you're talking about companies spending billions on AI infrastructure, that kind of customer concentration actually represents incredible pricing power. Now for the biggest surprise of all, Bill Ackman's Amazon conversion. For years, Bill Ackman was the famous tech stock skeptic. He avoided the Magnificent Seven completely, calling them overvalued bubble stocks. Then, August 2025 happens, and Pershing Square drops $1.3 billion on Amazon, making it 9% of their entire portfolio. This is Ackman's biggest tech bet ever, and his first entry into the Magnificent Seven. What changed his mind? The perfect storm started with Amazon getting hit by tariff fears earlier in 2025, creating what Ackman called an attractive entry point. But when you look at Amazon's Q2 2025 results, you see why he couldn't resist anymore. Total revenue hit $167.7 billion, up 12% year over year. North America brought in $100.1 billion, up 11%. International revenue was $36.8 billion, up 16%. But the real story is Amazon Web Services. AWS generated $30.9 billion in quarterly revenue, up 17.5% year over year, putting them on a $123 billion annual run rate. Despite all the talk about competition from Microsoft Azure and Google Cloud, AWS maintains its market leadership with 30% market share versus Microsoft's 20% and Google's 13%. They generated $10.2 billion in operating income with a 33% margin. And here's the number that really caught Ackman's attention. AWS has a backlog of $195 billion, growing 25% year over year. Amazon is spending $32.3 billion in quarterly capital expenditures. And this isn't just about e-commerce logistics anymore. They're building the AI infrastructure backbone that will power the next generation of cloud computing. When you combine that with Federal Reserve rate cuts reducing their borrowing costs for this massive expansion, plus the boost to consumer discretionary spending that benefits their retail business, you start to understand why Ackman couldn't stay away any longer. Speaking of Federal Reserve rate cuts, we're looking at the perfect storm setup for all 3 of these stocks. The September 16th to 17th Fed meeting has a 90% probability of delivering a rate cut according to market pricing. Lower interest rates create a triple benefit here. Healthcare companies like United Health benefit from reduced financing costs for their operations and expansion. Technology stocks like NVIDIA benefit from lower discount rates used in discounted cash flow valuations, making their future earnings worth more today. and consumer discretionary companies like Amazon get a boost from increased economic activity as borrowing becomes cheaper across the economy. Now let's be realistic about the risks because smart money isn't infallible and these investments aren't guaranteed winners. United Health faces the ongoing risk that medical cost inflation could continue accelerating beyond their pricing adjustments. And there's always the possibility of regulatory changes to Medicare Advantage or broader healthcare policy shifts that could impact their business model. NVIDIA's extreme valuation at 50 times earnings means any disappointment in AI spending could lead to severe multiple compression. Plus, they're dealing with China export restrictions on their H20 chips and growing competitive threats from AMD and custom AI chips being developed by major tech companies. Amazon faces intensifying competition in the cloud market from Microsoft and Google, both of which are investing heavily to gain market share. Their high capital expenditure requirements mean they're constantly spending billions to stay ahead, and there's growing regulatory scrutiny of their market dominance across multiple sectors. These are real risks that could impact returns, but the smart money is clearly betting that the long-term secular trends outweigh the short-term challenges. Here's the bottom line that ties everything together. The convergence of legendary investors around these three stocks reflects three distinct but complementary investment themes: healthcare's inevitable demographic tailwinds as the population ages, AI's transformational infrastructure spending that's just getting started, and digital commerce's continued expansion into every aspect of business and consumer life. With combined market capitalizations exceeding $7 trillion, these positions represent the smart money's highest conviction bets for navigating an environment of falling interest rates, continued AI adoption, and aging demographics. The timing appears absolutely strategic. Each stock faced temporary headwinds that created attractive entry points for patient capital, while the long-term secular trends remain firmly intact. United Health's medical cost inflation crisis created a 45% discount to intrinsic value. NVIDIA's extreme valuation scared away short-term investors just as the Blackwell ramp was accelerating. Amazon's tariff concerns provided the entry point that finally convinced even the biggest tech skeptics like Bill Ackman to jump in. For investors looking to follow institutional lead, these three stocks offer exposure to healthcare recovery, AI infrastructure leadership, and e-commerce dominance through companies with proven competitive moats and experienced management teams. The smart money has created the roadmap. Now you have it too. If you found this analysis helpful, smash that like button and subscribe for more institutional investor tracking, because following the smart money has been one of the most reliable strategies in market history. And these billionaires are placing their biggest bets right now. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.